Imagine reporting the highest revenue in your entire company's history, hitting nearly $110 billion in just 3 months, and then watching $500 billion of value vanish in a single day. Almost nobody is paying attention to why this happened, but the reason is hiding in a single, incredibly candid admission from the world's most powerful CEO. Today, we're diving into this explainer to uncover how a hidden AI tax is humbling tech giants, and what this massive wipeout means for the price of your next phone.
So, picture this. It's Cupertino, July 2026. Apple just dropped a record-breaking $109.4 billion June quarter. Sales were up absolutely everywhere, showing a 16% year-over-year jump. Device sales were off the charts, with the Mac jumping 29% and the iPhone hitting all-time June quarter records. By every traditional metric we use, this was a massive, undisputed win. But then we hit the paradox. Despite that massive win you see on the left, the company immediately watched its stock crash by about 6% after hours, ultimately wiping out roughly $500 billion in market cap. To be clear here, Apple didn't lose $500 billion in physical cash, they lost market capitalization, which is the value investors place on its future. So what exactly went wrong?
To figure that out, we're going to walk through 5 things: the record quarter paradox, the AI capex outlier, the silicon supply squeeze, the AI layoff contagion, and finally, the end of an era.
All right, let's start with part 1, the record quarter paradox, and peeling back that $109.4 billion headline.
When we look directly at Apple's income statement, we see those flashy headline numbers front and center. Net income hit a whopping $29.7 billion, alongside a 29% jump in diluted earnings per share, landing at $2.02. On paper, it looks absolutely flawless.
But here's the catch, right? There is a crucial, hidden asterisk. Buried in the financial data is a one-time tariff refund of roughly $2.19 billion, tied to a Supreme Court ruling. This single, isolated event artificially inflated their gross margins by about 2 full percentage points and contributed 11 cents to that earnings per share. When you strip away that one-time refund, the financial victory just isn't quite as absolute. It's a great quarter, for sure, but it wasn't a clean sweep.
But honestly, the real trigger for the stock crash was all about the future. Their guidance for the next quarter aimed for just 9 to 11% growth. And the market? Well, investors demanded 12%. The result was a brutal stock crash, simply because adequate just wasn't enough anymore.
Which brings us to part 2, the AI capex outlier, or the hidden cost of renting.
So you might be wondering, why the weak guidance when iPhone demand is clearly so high? The answer is a massive hidden AI tax. Apple is a total outlier when it comes to capital expenditures for artificial intelligence. They're spending roughly $13 to $14 billion on AI infrastructure. But if you look at the top 4 hyperscalers, they are spending a combined $700 billion plus. That is 50 times more than Apple. It's not even close.
Because Apple decided to rent their AI compute power rather than build it from the ground up, they're getting completely outmuscled. Giants like Microsoft and Meta are aggressively scooping up every advanced chip on the planet. And because of that, Apple is left paying the ultimate supply chain tax.
This leads us right into part 3, the silicon supply squeeze, and a rather shocking admission of defeat.
And that brings us to this stunning quote. Tim Cook, the undisputed king of hardware, the guy known globally as a supply chain genius, candidly called it a demand forecast miss. He flat out admitted they simply didn't foresee this capacity squeeze on the advanced nodes that manufacture their chips. Because those hyperscalers are hogging the global capacity, Apple literally cannot build enough devices to meet demand.
Now let's look at part 4, the AI layoff contagion and the very real human cost of all this.
While Apple is fighting tooth and nail for hardware components, the rest of the tech industry is bleeding. According to SkillSyncer's Live Tracker, as of August 2026, over 205,000 tech workers have been laid off this year alone. To put that in perspective, that averages out to nearly 1,000 job losses every single day. And here is where the data gets super sharp. A staggering 54% of these layoff events, affecting over 170,000 workers, explicitly cite AI and automation as the primary driving factor. Companies are gutting traditional roles and using the cash savings to buy AI data centers, advanced chips, and tooling.
Just take a look at who is actually doing the cutting. The very same hyperscalers scooping up Apple's needed chips are the ones shedding the most jobs. Oracle, Amazon, Meta, Microsoft. They're balancing massive AI infrastructure investments by slashing their own human workforces. It's a massive pivot.
What you really need to take away from this is how the labor market is physically transforming right in front of us. On one side, traditional roles like customer support, basic coding, and data entry are being rapidly replaced. But on the other side, huge new opportunities are opening up. Jobs in machine learning, prompt engineering, and AI safety are in massive demand. The market is aggressively rewarding the people who are building the AI future.
So how do you actually protect yourself in this wild 2026 landscape? Well, the data strongly suggests you've got to pivot your skills. First, develop AI literacy. It's the new baseline, kind of like how basic computer literacy was 20 years ago. You need to focus on complex problem solving that AI can't easily replicate. Upskill in prompt engineering, and most importantly, learn to adapt to AI-human collaboration. You absolutely have to learn to work alongside these tools, not compete with them.
Finally, we reach part 5, the end of an era, transitions and delays.
Let's zoom back in on Apple for a second. This massive transition is fundamentally changing your experience as a consumer. Apple's much-anticipated Siri AI is coming this fall, but it's going to be heavily staggered. It's delayed by regulatory walls in the EU, and it's stuck behind separate approvals in China. The era of a unified global Apple launch? Yeah, that's pretty much over.
Adding some incredible weight to all of this, this Q3 report unfolded during Tim Cook's 90th and final earnings call as CEO.
Cook is handing over a massively wealthy company to John Ternus, but it's a company that is suddenly super vulnerable. The tech value crown is being fiercely contested, likely returning to AI-first giants like NVIDIA. Ternus is inheriting a severe supply squeeze and an infrastructure world that Apple just doesn't control anymore. History isn't only written by leaders, it's shaped by the giants who fail to see the next wave until it's already crashing.
Which leaves us with one final urgent question for your own career and your investments. As this massive tech shift reshapes the global economy, making devices more expensive and redefining millions of jobs, are you renting your future or are you building it? If you want to survive the 2026 tech shift, make sure to subscribe. We track the data so you don't have to. I'll see you in the next explainer.